Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering a few of the Secure 2.0 Act provisions that go into effect in 2023. We'll be covering the Act and the retirement-related provisions that both your individual and business clients need to know about at our Secure 2.0 Act webinar on February 3rd. You can see a topic list and get signed up at spidell.com under webinars. The purpose of the Secure 2.0 Act, which was passed as part of the Consolidated Appropriations Act of 2023 and signed into law on December 29, 2022, is to expand retirement savings for workers. At 358 pages, the Act contains many provisions that go into effect over a number of years. This week, we're covering a few of the provisions that go into effect in 2023. Under the Secure 2.0 Act, the current mandatory age to begin taking required minimum distributions is increased from age 72 to age 73 for those who turn age 72 after 2022, and age 75 for those who turn age 74 after 2032. The Act also allows for the creation of Roth Simple and Roth SEP IRAs for taxable years beginning after December 31st, 2022. This gives practitioners the ability to do some retroactive tax planning because the account can be set up after December 31st. The original Secure Act allowed employers to adopt new retirement plans by the due date of the business's income tax return or the due date of a sole proprietor's personal income tax return. These plans are treated as if they were established on the last day of the preceding taxable year. New retirement plans that are adopted after the end of the taxable year but by the due date of the business's income tax return are permitted to make deductible employer contributions by the due date of the return. The Secure 2.0 Act expands this provision to allow deductible employee contributions by the due date of the tax return, not including extensions, but only for plans established by sole proprietors, including single-member LLCs, where the sole proprietor is the only employee of the business. This provision applies to plan years beginning after December 29, 2022. The Secure 2.0 Act increases the credit for small employer contributions by an applicable percentage of employer contributions other than elective deferrals to an eligible employer plan other than a defined benefit plan, up to a $1,000 maximum credit per employee. Contributions made for employees who receive wages in excess of $100,000 are excluded from the calculation of the additional credit. The wage limit is increased for inflation for taxable years beginning in a calendar year after 2023. The credit is phased out for employers with 51 to 100 employees by 2% for each employee for the preceding taxable year in excess of 50 employees. And while the original credit allowed for a small employer's startup costs can only be claimed for 3 years, the additional credit for small employer contributions can be claimed for 4 years. The February issue of Spidell's Federal Tax Letter will extensively cover more Secure 2.0 Act provisions, including the expansion of Roth-type accounts, retirement contribution modifications, and more. For subscription information, go to spidell.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's Federal Tax Minute.